Okay, we might jump into it now. Thanks, guys, for coming. As I said earlier, like, feel free at any stage to just jump in with questions. I'm gonna try to I've just got like a bunch of things that I want to talk about on the right, so you can kind of follow along as I go, and I'll open up a bunch of web pages here and there to just show you different resources that you can use. And so the plan is kind of to start out with like investing generally, why it's a good time to invest, then going into like what you're actually investing in when you invest in equities or shares. And then finally, like we'll do a bit of a dive into cryptocurrencies just at a very high level, and some of the ways that you can think about getting invested in crypto. So first of all, why is it a good time to invest? So lots of people will probably have seen that the markets have taken a pretty significant hit recently. So lots of people are starting to think about investing, or maybe your parents have said get into the markets, or maybe you've just seen friends make, hundreds of percent on some crazy investment and you thought, well, why am I missing out on that? I think just at a high level, it's important to understand the markets, even if you don't decide to invest, because it's one of those things that kind of touches almost everything that you do. So the more you understand about the financial world, even if you decide at the end of this that you don't want to invest any money, the better off you'll be. So the first thing, or the first reason that you might want to start investing, is this concept of compounding. So compound interest is extremely powerful, and the earlier that you start investing, the more money you can turn your current investment into over time. So the essential premise is that okay, like this is a pretty extreme example, but it's the idea that small investments now can turn into massive gains over time. And if you take a look at this chart, it shows that if you basically invest $5 a day instead of buying a $5 cup of coffee, it can turn into pretty substantial wealth if you're earning 10% on that daily. But the essential premise of compounding is that when you invest, let's say $100, and you earn 10% on that in a year, so at the end of the year, you'll earn 10% on $100, which is $10. And so the balance that you start with in year two is now $110. And so then if you're earning 10% on that at the end of that year, you're earning $11. And so over time, that has a pretty substantial effect at building up the value of your investment over time. So the idea is that the sooner you start, the earlier in life you start, the power of that compounding over 50, 60, 70 years is substantial. And this is just kind of a little illustration of it. People always use the $5 coffee thing. Like if you don't buy a cup of coffee, then you can, like invest that and make serious money. I think it's a stupid example, honestly, because like, don't forgo your fucking coffee just to like buy into this or subscribe to this idea that your $5 coffee can turn into millions over time. But that is just an illustrative example. Okay, the second one is to escape inflation. So you've probably seen that nobody's really got a control or got a handle over inflation at the moment, which is pretty problematic for a number of reasons. And so investing is an opportunity to escape inflation. And the idea of investing to escape inflation is a hope that you can earn more money on your investments than the value of money that is inflated away over time. So what does inflation actually mean for the value of your money? Inflation essentially means the devaluation of the money itself, or in other words, a reduced capacity for you to use that money to buy things. And so you've probably seen it in the supermarkets that the price of everyday goods, punnets of strawberries, blueberries, and all those types of things, and milk, the prices of them are increasing pretty substantially. And so what it means is, with $100 that you've earned, working in whatever job you're doing, now can't buy as many goods. So it means you have an increase in expenses, because to buy the same goods, you're spending more money. The second one, and another really important one, is that your savings accounts are losing money every single day. So if you think about your savings account with Westpac or NAB or CBA, it's probably paying out something like around 0.35%. And so that if the current inflation level is 5.1%, which it is in Australia right now, it means that your money is losing 4.75% every single year just by sitting in a savings account. So most of us think, oh, savings account's great. Like we're earning 0.35% a year on our balance, and you watch the money come into the account monthly. But what is not being accounted for is the fact that everything you want to buy is getting more expensive because the value of money is getting deflated away. Now, if we think about why that's happening, the US is a good example for it. And to just take a look briefly at the amount of money that's been printed in the US over the last 2 years. So you can basically see that there's been a substantial amount of money printing in the US. And I think it's like 40% of all of the money, all the US dollars that are currently circulating were printed in the last 2 years. So essentially that money, that money can only be buying the same amount of goods. And so the inflation is now getting caught up, and inflation in the US is at 7 to 8%. And in Australia, the RBA has just posted recently that the latest inflation in Australia is 5.1%. So as I said, again, your money is losing 4.7% every single year. And so what that basically means is that 4.7%, 4.75% is your hurdle rate when you think about investing. So you need to be making more than 4.75% in order to be making money on your savings. Yep, Kira?
I was just going to say, so the concept then is that we're trying to out earn the losses from inflation. So by taking on more risk, is that like the concept of comparing a savings account to investing in something?
Yeah, exactly. And so the reason that this is so problematic is because obviously it requires you to take on risk to invest in equities, and equities, as far as an asset class goes, are on the riskier end. And so you'll hear this phrase of like chasing yield. And what that basically means is that people are getting forced further and further up the risk curve in order to make sure that they're not losing money, in order to break this hurdle of the real interest rate, which is the difference between the RBA's cash rate and inflation. And just for people who don't know what the cash rate is the money is the rate at which banks can borrow money from the RBA. Now, the RBA is the Reserve Bank of Australia. It's our central bank. In the US, it's called the Federal Reserve, which is often abbreviated to the Fed. And so this is the rate at which banks borrow from the RBA. And so usually your interest rate that you'll get paid out is going to be either exactly this rate on your savings account, that is going to be either exactly this rate or slightly less than this rate, because the bank wants to make money, rather than pay out more than it's, or basically more than it costs them to borrow it in the first place. Cool. So then the third reason, as I mentioned earlier, is that the stock markets have seen a pretty severe correction. Actually, sorry, let me just show you this quickly. Remember how I said like 40% of the money in the US has been printed in the last 2 years? You can see that the circulating money supply in the US was around 35 trillion, something crazy. I'm not even going to try to figure out what that was. It might be like, yeah, okay, I can't be bothered. But basically, it was at 35, whatever we're talking, like it could be trillion, probably trillion, and it's gone from 35 to 60 trillion in the span of 2 years. So all of this extra money circulating in the economy basically leads to extreme inflation. And it's only now that the Fed has started to raise interest rates as a mechanism to counteract that inflation. I'm not going to go too much into the economics of why that is, but essentially they've printed way more money than they needed to in order to avoid an economic recession during the COVID period. And now we're all paying for it in rampant inflation, which is quite helpful. Okay, so next thing, the current market correction. I've just pulled up the three main ones that you guys should think about when you're looking at markets generally. The first is the S&P 500, which is the largest 500 companies in the US. The reason we often look at US stock markets as a proxy for what's going to happen in Australia is because, as you guys all know, the global economy is very interdependent and interrelated. So what happens in the US usually has a huge knock-on effect to what's going to happen in Australia. So you can see here the S&P 500 is down 16% year to date. The NASDAQ's down 25% year to date. And the ASX 200 is down about 6.5%. And so most people would look at that and say, okay, this is a great buying opportunity, because as you can see here, stocks are currently cheaper than they've been since around December 2020, back here. And so, people see, oh, okay, well, the high of the NASDAQ was 16K and now it's down to 12.5K. So maybe now's a good time to get in. Now, I don't think that buying the dip is very good investment advice. And that's because usually it just implies that you should just YOLO your money into an index just because it's gone down from where it was before, which usually isn't isn't smart, because most people nowadays, especially with the advent of things like Robinhood, your superheroes and stuff, it's become easier and easier for everyday people that don't really understand finance to start investing. And that's great for a number of reasons. But I think you don't want to be one of those people that's just investing because someone told you to. You do really want to do your best to understand what you're buying, the different risks involved, and also to have a long-term view on what you're buying and why you're buying it. So that's that first point. The second point is you also want to think about how much you're buying. So this all comes down to risk tolerance, obviously. But you have to realize that investing in stocks is extremely risky. So you want to think about what percentage are you buying, like what percentage of your total net wealth are you investing in stocks, and how much would you be willing to lose? And this is extremely important when you start talking about crypto later on. But it's important to think about how much you want to allocate as a percentage of your net wealth to the investments that you make. And then linked to that is understanding your time horizon. So this is something that people don't think about too often, especially when they're kind of blindly YOLOing into a dip. And it's that the value of investing is really in compounding. And that's where we started. And you can only compound your wealth if it's invested in the market. And so you really ideally want to be able to invest in something that allows you to kind of just set and forget, which means it's money that you, A, are willing to lose, but B, will not need urgently in the next, even take it out to 5 years. So if I have $5,000 in my bank account, if I'm going to need all of that money in the next 5 years, let's say because I don't have a job or because I don't back myself to make more money than I'm spending, then it's probably not a good idea to invest 3K of that in the markets, because you don't want to be forced to liquidate your investments or sell your investments when you urgently need money, because then they're out of the market, then they're not compounding, and you're also at the beck and call of the market. So if we think about that example practically, if you'd invested 3K up here, right, you didn't know where the top was, you didn't know where the top was going to be, but you needed that money urgently now, well, then you have to cash out at whatever, a 25% loss. So ideally, you don't want to be exposed to the beck and call of what's going on in the markets at the time. You want to have the freedom to cash out when you want to, and also to rebalance things without copping a loss. So you also need to understand the time horizon. And that's a bit more of a complex idea, right? Because it doesn't mean necessarily that all of your money has to have the same time horizon. It just might mean that certain investments you make, you're expecting to have invested for the longer term. And then you might have some allocation, let's say 20 or 30% of your total invested wealth that you keep for more speculative things with like a 6-month to a 1-year time horizon. So think about the time horizon of all the money that you're investing and whether or not you can kind of subdivide that into different horizons for different opportunities. And then finally, a really important thing to understand about investing is that the stock market is not exactly a proxy for the economy as it currently stands. It's what's called a leading indicator. And that's because stock prices are essentially what amalgamate to form the index, are an expectation, is like a leading indicator of what investors expect is going to happen to stocks over the coming years. Now, there's a reason mathematically for why that is, and it's at a high level because the way that we value companies is based on their future earnings. So therefore, the price of stocks that make up an index are based on how much money we think that these companies can generate going forwards. And so the market is not actually a reflection of how the economy is now, but an indicator of how investors believe that the economy is going to look 1 year in the future, 2 years into the future, 3 years into the future. So you do have to understand that the market has dipped for a reason, and it's because investors are expecting a downturn. However, having said that, the reason that buy the dip is usually a phrase that you'll hear is because money is usually made in downturns, or also known as bear markets. And it's because it essentially requires you to have a longer term view, or a view of the market that it's going to recover either in the medium term or the longer term. Now, of course, you'll never know that. And so that's why it is risky to just buy a dip because someone told you to. And also it's impossible to time the markets because you don't know where the bottom's going to be, and everything is priced in, which we'll talk about a bit later. And then fourthly, you've got no money. So it's a great time to invest. Now, I'm assuming most of you aren't sitting on huge bags of cash, and it's actually a good thing because you want to learn all of your lessons when you have the least amount of money that you'll ever have. Now, obviously early in our careers, even at the start of uni, when I first made my first investment, the money that you have now is going to feel like a lot of money, but in the grand scheme of things, it's actually the least money that you'll ever have. So theoretically, that means that, you know, you have the highest risk tolerance and highest appetite for risk at your current age. And then on top of that, you have the least financial liabilities that you'll ever have. So remember earlier how I talked about time horizon and how important it is to understand the length of time that you expect to have your money invested. Your time horizon can basically be confined, and will be confined as you grow older, because you'll have all sorts of financial liabilities like, you know, mortgage payments, school fees, you know, all of those types of liabilities, gas, rent, utilities, all of that sort of stuff. And so, you know, now when you're living at college and have the least financial liabilities that you'll ever have, you can afford to put more of your money into the stock market if you so choose. Is that a question? No. Okay. And then finally, just understanding financial markets and investing just gives you a better perspective of what I've called the big bad world. Because as things like the truth of the way the world works is that pretty much everything is influenced by the economy, and everything is influenced by financial markets. All the products that you use on a day-to-day basis are impacted by whether or not these companies can get funding, what the investor sentiment towards them is, how well functioning their board and management is. And so having an understanding of financial markets, finance generally, and investment is just super, super useful for your general knowledge. And so by investing, however much money you invest, you'll find that you're looking at the markets more often. You're reading, you know, news articles from the Wall Street Journal or the Australian Financial Review, and you're just a bit more engaged generally with what's happening in markets. And that bodes well not only for your own life, but for anyone considering a future career in any kind of finance or financial services, or just having conversations with people. It's always useful to have an idea of what's going on around the world. And finance is a huge part of the world. And then finally, I've just got like a little picture for you guys of my first ever investment back in 2018 when I was a fresher in May. I bought Westpac at $29. And as you'll see, that was a shocking investment because Westpac has only gone down from there. So fortunately, you know, I put 1.8K into Westpac back in 2018, learned a lot of lessons. And, you know, that's what kind of kickstarted my investment journey. Felt like a lot of money then. It was a lot of money then, but now I can kind of look back on it and say, okay, cool, that was my first investment. And that's what kickstarted this 4.5-year journey now of learning about the economy and getting involved in finance. So the earlier you start, the better. And I highly recommend that you guys think about getting involved now because there's loads of good reasons to do it. Cool. So now let's pivot slightly to looking at what shares actually are. Now, for anyone studying finance, I apologize, it's going to be a bit of a back to basics, but you know, the better you understand the fundamentals, often the better that you can actually implement them when you start thinking about strategies to make money. So a share of stock fundamentally is a unit of ownership in a company. Now, companies will have millions of individual shares on issuance. So if we take a look at Westpac here, is it going to tell me? Probably not, because that would make things super helpful. So these companies, okay, so you can see here, Westpac has 3.5 billion shares outstanding, and each share represents a unit of ownership in Westpac as a whole. Now, obviously, you and I, we all realize that that doesn't mean that you're making decisions for Westpac on a day-to-day basis, but it means that you have an entitlement to any dividends that they pay, and also to vote on matters at the annual general meeting of the company. And that has, power if you can, I mean, obviously we're not going to be holding enough stocks to actually impact the board decisions of Westpac, but over time, as you get wealthier and wealthier, the percentage of shareholding that you own in a company is extremely influential. And so there are a couple of ways that you can make money on shares predominantly. The first is capital appreciation, which is a result of the share price of the company that you've bought appreciating in value. And then the second is dividends. Now, a lot of companies that people are invested in these days don't actually pay dividends. And that's because smaller growth stage companies, especially tech stocks, all the big names, your FANG companies, in fact, that they pay dividends now. But as companies are growing, usually they want to reinvest the earnings, the income that they make back into the development of the business. And so therefore they don't pay out dividends because they need to they want to use that money to basically supercharge the growth of the company. So most companies you'd invest in wouldn't pay dividends. And so therefore you'd be looking for capital appreciation as the main way to make money on shares. The next thing I want to talk about is just the difference between individual shares, ETFs, and funds. Now, despite just showing you my first investment in Westpac, my general advice is actually not to invest in individual companies. So you saw my Westpac investment, it's down basically. It's been down for the last 5 years. I think I sold that a while ago, but the reason that you don't want to invest in individual shares is because it's extremely difficult to find information that gives you an edge. And the phrase that people use is that everything is priced in. And there's a nice little paragraph I'll read here from Wall Street Bets, a very funny Reddit thread, which basically just says that everything is priced in. So you, especially given that most of us are, in our late teens, early 20s, we don't have any financial experience. It's very, very unlikely that you can come up with an idea of some reason that Westpac or Google is mispriced. And that's because the stock prices in pretty much every possible event that you can think of. So don't even ask the question. The answer is yes, it's priced in. You think Amazon will beat the next earnings, which means you think that they'll actually do better than what Wall Street expects in the next earnings report. It's already been priced in. You work at the drive-thru for McDonald's and found out that the burgers are made of human meat. It's priced in. You think that insiders don't already know that. The market is an all-powerful, all-encompassing being that knows the very inner workings of your subconscious before you were even born. Your very existence was priced in decades ago, and the market was valuing Standard Oil's expected future earnings based on population growth that would lead to your birth, what age you would get a car, how many times you would drive your car every week, how many times you take the bus or train. Anything that you can think of has already been priced in. You have no original thoughts. Your consciousness is just an illusion, a product of an omniscient market. Free will is a myth. The market sees all, knows all, and will be there from the very beginning of time until the end of the universe. Anyway, you get the point. So the general advice is it's better to go for some sort of basket of stocks rather than trying to invest in individual shares, because that way you're betting on usually the direction of the market as a whole rather than trying to find advantages in individual stocks. And so, if you do want to dabble in individual shares, that's fine. But something you have to realize is that your benchmark for investing in individual shares should always be whatever the market's returning. So if you were to invest in the ASX 200, which is the 200 biggest stocks in Australia, or the S&P 500, as we've already looked at, the largest 500 companies in the US, that is your benchmark because that is the easiest investment that anyone can make. So if those investments are returning 8 to 10% a year, then any stock that you invest in individually needs to be returning more than that for you to justify doing it and taking on the additional risk associated with an individual stock. And that obviously requires extensive knowledge, not only of the company that you think you want to invest in, but also what's going on in the market, what are all the things that could impact the company, and why, these Wall Street bankers who have extensive algorithms and all of the best resources haven't already thought of it. So that's essentially why I would advise against investing in individual shares. And then secondly is the importance of diversification. Now you'll see this word basically in any beginner investing platform. And the general reason for that is because you want to eliminate something called idiosyncratic risk. And idiosyncratic risk is the risks associated with individual companies and are therefore diversifiable risk, in that you can get rid of that risk by having a portfolio of a larger number of stocks. So here you can basically just see that the total risk of your portfolio decreases as you hold more and more stocks in it. So rather than just holding Westpac, I might hold all 4 of the banks, and that'll pull me down this risk curve and get rid of this unsystematic risk associated with the individual companies. And then over time, it converges to just the systematic risk, which is just whatever the market risk is. I'm not going to go into too much detail with that, but essentially diversification is your friend. You want to hold more stocks rather than less. And that's why investing in things like ETFs and funds can be helpful. So let's dive into ETFs directly. So an ETF is an exchange traded fund. Now, they differ slightly from other things called mutual funds. And the basic way to think about it is that ETFs are exchange traded, which means they're actually listed on an exchange, whereas things like mutual funds, you have to buy directly over the counter, and it's not over a physical counter. It's over like a technology counter. Like you'd create an account with BetaShares, for example, and you'd buy one of their mutual funds directly on their platform, but it's not traded on the broader exchange. So the most common ETFs to think about are what are called index ETFs. Now, the largest ETF providers are companies like BetaShares, VanEck, Vanguard, and iShares. And I'll just give you a basic rundown on what to look for on these pages. So every single exchange traded fund will have like a snapshot page like this. It'll start out with, and you can see kind of all the different funds that they have in BetaShares, and all of these companies have their own ones. Some things to look out for. That's the ticker. So if you ever want to search for an ETF in Australia, you can search the ticker plus ASX. So if I wanted to look up A200, I could just go A200 ASX, and it'd give me the performance of this ETF. And then you can change that time horizon and take a look at how it's performed. The other thing that you'd want to look at on these pages are what stocks they're holding. Now, it's less relevant for an index ETF, because index ETFs will basically just take the largest companies within a given country. So in this case, A200, it's the largest companies in Australia. And it'll weight them according to their market capitalization, which basically means weighting them in accordance with how big they are. So here you can see that BHP has the biggest weighting in this A200 fund, because it's the largest company currently in Australia. And what they do is they rebalance this portfolio. So they buy and sell in order to rebalance the portfolio either weekly or monthly or 6 monthly. And that's something that you also want to check, right? Because companies' share prices change on a daily basis. Like every weekday when the market opens, BHP's stock is going to go up or down. Commonwealth Bank's stock is going to go up and down. And as a result, its size relative to every other company in this Australian market is going to change. And so the frequency of reweighting is actually quite important to think about as well, because that's going to impact the returns. The idea of this index ETF is basically just to track the performance of the Australian market as a whole. And so by investing in it, you get access through this fund to 200 companies in Australia. And it's the largest 200 companies. That's kind of like your market index. And you can see how well this has performed over time. So the other distinction I just make is that there's a difference between the market itself, like the index itself, and these ETFs. So you can see that this ETF is priced in Aussie dollars because you can buy units in the ETF for $121. The index itself is not something that you can invest in. It's just a synthetic value that changes over time based on the constituents of the index. So you can't invest in the index. This isn't a price. It's just a value that you track over time. And what you're hoping is that these index ETFs are rebalancing frequently enough such that it maps the performance of the index. And so, as you can see here, the A200 index ETF has pretty much perfectly mapped what the index has done, which is what you want. But you do have to realize that they're not actually the same thing. You're not investing in the index by buying this. You're investing in beta shares as ETF that is supposed to track the index. And then the final thing you'd want to check on these is the fees. So all of these ETFs, because somebody has to manage them, somebody has to rebalance them, they have to charge a fee. Oh yeah, Zoe, do you want to ask a question?
Yeah, just in terms of like investing into, say, beta shares, do you have to do that through their company, like through this website?
Yeah, so you don't, because this is an exchange traded fund. So most exchange traded funds will be listed on whatever stockbroking platform that you're using, whether that's CMC or ComSec or NabTrade. These will most often be like, you can buy them directly in those apps. Whereas what I was saying before about mutual funds is there are some funds that aren't listed on the exchange. And so you'd have to make an account with them directly in order for you to buy those funds.
Yeah, perfect. Okay, thank you.
So yeah, so I was just saying the other thing you'd want to take a look at on these pages is what the cost is. So this one charges 0.07% per annum. And the reason that it's so low is because index ETFs, there's no active management. Nobody's actively choosing which stocks go into this fund. They're simply taking a look at the index, saying which are the biggest companies in Australia, and then weighting the portfolio automatically. And they'll have algorithms that can automatically rebalance the ETF such that it tracks the index perfectly. So that's why management fees are extremely low, but then you do have to realize that this is getting automatically taken out of the balance that you have invested them every single year. So that's kind of another hurdle rate that you need to add to inflation that you need to essentially outperform. Because if the market's flat, if the market doesn't return anything, then you're actually losing 0.07% of your investment. So it's always good to be aware of fees. You can also do a calculation, however much you're going to invest, just multiply it by the fee per annum, and you can see how much they're going to be charging you. Weightings of the investments. Okay, and then the other thing to look at is something called thematic ETFs. So this is an index ETF, which is literally just tracking the ASX 200 index. There are also funds that take an active stance and actually invest in specific types of companies. So if we go back to the fund categories and just take a look at the beta shares ones, they have a fund called the Asia Technology Tigers. And you'll see that this has a very, very, very different constitution to the ASX 200 ETF. And the goal of this one is to gain exposure to the technology tigers leading Asia's technological revolution. So again, we can take a look at this. We can see what's the ticker name. It's Asia. If we want to look at that, we can just search up Asia ASX, and then basically see how it's performed. We'd also want to take a look at which companies it's invested in. So as you can probably imagine, the biggest companies will have higher weightings. But the whole idea is that somebody is actually choosing which companies to invest in. And so as a result, we'll probably find that this has a much higher management fee than the index ETF. Yep, you can see it's 0.67%. So it's 0.6% higher than just investing in an index ETF with beta shares. And that's because there's actual management that has to go into deciding which stocks to hold, and then also what weightings that they should hold within this ETF. The other thing just conceptually to understand with ETFs and funds is that from my understanding, you don't actually hold the shares in Tencent, for example. Like you hold 1 unit, for example, in the Asia ETF, and that ETF is performing based on Tencent, based on Samsung Electronics, based on Taiwan Semiconductor, and those shares, the shares of all of these companies, are held by beta shares themselves. So you don't actually own these assets. You own a fund which is synthetically tied to these assets, which are held in these proportions and these weightings by beta shares themselves. So that's an important thing to understand as well. Yeah, has.
If you can have access to seeing what these are invested in, what's stopping you from just investing in these yourself, just buying stocks on these?
Yeah, that's a good question. So the reason why you might want to buy an ETF over buying these stocks individually in these proportions is because as retail investors, which is what you'd refer to us as, just individual people that are buying stocks, you pay brokerage fees every time you make a trade. So if you want to build a portfolio of 100 stocks and you're paying $20 brokerage fee on every single buy, then the cost of building this position racks up substantially. And then on top of that, remember how I mentioned that rebalancing gets done pretty regularly? So if we take the A200, for example, every time you want to rebalance, you'd have to either buy or sell the stock to increase or decrease the weighting. And it's going to take you ages to do that because you have to buy or sell 200 stocks every week to rebalance it. And B, you cop the transaction fees, the brokerage fees every time you make a trade. So they'll do it for you automatically and just charge you whatever the management fee is annually. And most likely, I can guarantee you that this management fee is going to be considerably lower than what it would cost you from a time and money perspective to build the position individually. But yeah, it's a good question. Most people just say, oh yeah, well, why don't you just buy them all yourself? It's because this is a much lower touch, lower cost way of building the same position. Okay, so now, I mean, there are a couple of different investment platforms you can consider. So obviously this is a bit more complicated. ETFs are complicated to the extent that you actually have to make an account with a brokerage platform, like ComSec is the biggest one, or like CMC Markets. Most of your bank accounts will have an attached investment brokerage platform that you can invest on. But usually those have pretty high brokerage fees. Like I think ComSec, if you're trading any balance less than $1,000, then you're paying $10 brokerage fee. Anything from like 1,000 to 5,000, you're paying a $20 brokerage fee, which is a fee that every time you buy and every time you sell. So that's that really adds up. I've actually got it like a little illustration of it here. If you're paying $5 brokerage on a $100 investment, it means that you have to this investment has to go up by 5% in order for you to break even on the brokerage. And it's actually 10% because when you sell, you incur another $5 brokerage fee. So that immediately sets a 10% hurdle on a $100 investment. So the solution is either A, find a platform that has lower brokerage, or B, invest more money. And so you can kind of see why there are other easier platforms where you don't have to worry about brokerage fees because they just create these funds for you. So probably a good time to pivot directly into Spaceship. Spaceship's a very well-known one. The idea is it makes investing super easy because you just create an account with them and then they facilitate you buying units in this fund. In this one's called the Universe Portfolio, in which they've chosen all of these stocks, so probably like 100 different stocks, and bundled them up into this fund that you can invest directly into. And as a result, you don't need to worry about brokerage because I think they just charge you $2.50 a month as a flat fee. And so you can just keep adding or buying and selling units in this fund without having to worry too much about all of the nuance of hurdle rates and brokerage fees, et cetera, et cetera. So Spaceship is an interesting one. It had performed extremely well because the Spaceship Universe portfolio, so they've expanded them, but the original one was just the Spaceship Universe portfolio, which was investing in companies which have a where the world is going criteria. Now, unfortunately, that includes a lot of very high growth, high risk stocks, like your Spotify's, Microsoft, Block, Apple, and those companies in the last 6 months, as we looked at, have had pretty significant declines. So if we take a look at this Universe portfolio, you'll see that it hasn't performed particularly well over the last 12 months. It's down 25% year to date, which is not fantastic. So again, like you could view this as a dip if you think that these companies are going to basically bounce back. But yeah, this portfolio hasn't done too well in the last 6 months following the decline in the broader market. So this is like a really easy one to get started. Another option is one called Raise. And what Raise does is it has a roundup feature that gets you into the habit of investing because it automatically rounds up payments that you make and invests it into a portfolio that you choose. And I assume it's without brokerage. Otherwise, that'd just be stupid if it did. So the idea is that you can choose one of the 5 portfolios that they have based on different levels of risk, and then every time you make a purchase, or like they'll round it up. So then they've got this thing about how much your money can compound over a given number of years if you're investing $30 every single month. So you can kind of see again the power of the compounding over time. And this is just another really easy way to just get into the habit of investing and then tracking how this is performing over time and taking a look at, what they're invested in, whether or not you believe in those companies, et cetera, et cetera. So that's another really popular one. Or if you want to go a bit more hardcore and you want to invest in individual companies, or you want to buy some of these exchange traded funds, my recommendation would be to use a platform like CMC Markets, or one called Stake. Stake's pretty good because it's a pretty user-friendly interface, and they have $3 brokerage fees on the ASX, so it's super affordable as well. Netra just wrote that raises $4 a month. So rather than charging you brokerage fees, a lot of these new platforms are just charging you a flat rate per month, so that you don't have to worry about getting charged brokerage every time you make a trade. So understanding the costs of the different systems is also quite important, so that you're not copying ridiculous amounts of brokerage and creating high hurdle rates for yourself. Some of the things that you want to think about when you're picking a stockbroking platform. Actually, I might show you CMC quickly, just because just to make the point that some of these platforms are a bit more complicated than things as simple as Stake or Spaceship or Raise, because these platforms are built. Okay, it's not showing me the platform itself. Okay, yeah, you can see here, this is the pro platform for CMC. So it's considerably more complicated than looking at, this nice thing with rounded edges and individual companies and how they performed in a really nice UI, versus some of these more complicated platforms that are a bit harder to navigate, especially if you're a beginner. So my recommendation is probably to choose one of the easier platforms. If these are the most simple, in that you don't really have to think about what you're investing in, because you just have to take a view on whether or not you like the companies they've invested in and choosing a portfolio based on your level of risk. But if you want to start picking individual stocks, or you want to invest in individual ETFs, I would recommend something like Stake to start with, or if you're a little more advanced, something like CMC Markets. Or if you want to keep things all in the same place, then maybe just pick the stockbroking platform that's linked to your bank account. So for example, opening an account with Westpac Investing or with CommSec, if your bank account's with CommSec, because then they'll show you your investment account and your debit account and your checking account and savings account all in the same place. So it's much easier to track if you just choose one of those. But then you have to remember that the brokerage fees on those are considerably higher than some of these newer options like Spaceship and Raise. But just some general advice when you're picking a stockbroking platform: brokerage fees often are often correlated with the features that you have access to. So if a platform is offering you is charging higher brokerage fees, it probably means that they have more features to give you. Whether that means different ways that you can get into a position. There's a discrepancy between something called a market order and a limit order. Not going to go into that detail, but some platforms only offer market orders. Another thing is live versus delayed data. If platforms are charging lower brokerage fees, they probably have delayed data, which means that you get your price data on individual stocks or funds 20 minutes later. So if the market opens at 10, then you only start getting data at 10:20. Also, you might want to take a look at whether other platforms offer international stocks or cryptocurrencies, if that's something that you're also looking at investing in the future. What's great about ETFs as well is, remember how we looked at the Asia ETF? This is actually giving you exposure to companies that aren't listed in the Australian Stock Exchange. Now, if you were to try to do this individually, and it's another reason as why you wouldn't want to buy these positions or buy these companies individually, is because you'd have to make an account with like a Chinese brokerage platform, or in this case, a platform that gives you availability of international stocks. And usually the brokerage fees on those stocks are higher because there's more admin that the platform has to do in order to buy and settle your purchase of those shares. So ETFs that are listed on the ASX can give you exposure to stocks that are listed in other exchanges globally. So you might want to take a look at whether they offer that, and then also what the brokerage is on those stocks, and then cryptocurrencies as well. Now, because cryptocurrencies are still relatively new, there aren't too many platforms that have cryptocurrency investment built in. Although I did see that Raise has this fund that has a 5% allocation to Bitcoin. So just by buying units of that fund, you're investing 5% of that investment in Bitcoin. Cool. Brokerage we've talked about to death. The final thing is just custody of shares. Now, this is something that is a little confusing. Don't worry if it doesn't make too much sense to you, because it's not going to matter too much for us. But there's something called CHESS sponsorship, which is a system in Australia which has to do with whether or not you actually own the stocks that you're buying. If a brokerage platform is CHESS sponsored, it means that when you sign up, you get given a HIN, which is, I think, like holder identifying number or something. And it means that whenever you buy stocks, they are actually legally in your name. Now, there are other platforms that, in order to cut down on admin costs and therefore charge you lower brokerage fees, they offer something called a custodian model, which means that you don't actually hold the shares in your own name. It means that they hold custody of the shares in a trust on your behalf, which doesn't sound like the worst thing, but theoretically it means that if any of these companies go bust, that you lose your shares and you go down with them, basically. So that's possibly an argument to go for a CHESS sponsored account. But then again, as I said, like, we're probably not investing the house. So it's okay to, especially when you're starting out, just start investing small amounts of money on Raise and Spaceship, and then consider transferring them out into a CHESS sponsored brokerage once you start getting a bit more serious. Does anyone have any questions on that? Nope. Okay. Does anyone have any questions on stock investments generally?
But really
Anything?
quickly, with the
Yeah.
transferring from custodian models to CHESS, are there fees associated with that?
Yeah, there probably would be. I think. Actually, now that I think about it, if you don't have legal ownership over the shares in a CHESS sponsored platform, then you might actually just have to liquidate and then rebuy the positions on a CHESS sponsored platform. I don't really know exactly how it works, because what I've done is I've moved from CMC to Stake, but both of those are CHESS sponsored. So it was just a process of them transferring my HIN and then transferring all the holdings from CMC to Stake. I don't know what it's like when you try to do it from a custodian model. My guess is that you'd actually have to sell. And in fact, you'd pretty much definitely have to sell, because Spaceship, for example, is a fund that you can only buy on the Spaceship platform, right? Otherwise, you'd have to actually create a fund or buy this fund of stocks somewhere else. And I don't think it's listed on any exchanges. So this would be an example of like a mutual fund, in that you can only buy it by having an account with the provider. So you couldn't transfer like your ownership of Spaceship into CMC, for example, because CMC doesn't offer this fund. Yeah. Okay. Finally, I realize we're kind of running out of time, but maybe we can do a follow-up on this if there's enough interest. But maybe to just give you a quick intro to cryptocurrencies. Also, if anyone has any questions on shares, just dive in, but I'm going to get started on crypto. I'll just set up like the base case for why crypto is now a thing, and why you might want to think about starting to understand it. And understanding it, as I believe, is like almost more important than you actually buying any of it. It just so happens that when you buy it, you usually stay more on top of it, and so you learn about it more. So yeah, I'll leave that one up to you. But the whole reason that cryptocurrencies have now come into existence is because the trust that we have in centralized financial institutions is quite honestly failing. As we looked at earlier, inflation is running pretty out of control. We had like the White House press secretary and the chairman of the Fed in the US just 1 year ago saying that inflation was just going to be transitory. It wasn't going to be permanent. It was just going to be a temporary blip while the monetary and financial systems sorted themselves out. I even bought a hat because I thought it was funny. The hat says it's transitory because that became a phrase that the Fed chairman Jerome Powell was using a year ago to say that inflation wasn't something to worry about. Yet here we are, inflation running out of control, markets tanking, and everyday people losing money on the value of their savings accounts in the US. The sad part about it is a lot of people don't even realize it's happening. Oops, I think I just pulled my mic out. Oops. Can you guys still hear me?
Yeah.
Yeah, okay.
Sorry, Dan, it's actually cutting out for me. I don't know if it's cutting out for anyone else.
Is it back now?
Yeah.
Yeah, I think it reconnected. Okay. Yeah, so it's pretty unfortunate. And then we've also looked at the money supply and seen that the government is printing money at a rapid rate. And that's going to have knock-on implications for the entire financial institution. And so basically people have just lost faith and lost trust with traditional institutions and their ability to manage money, which is obviously central to pretty much everything that we do. And so cryptocurrencies were invented as a way for people to opt out of the traditional financial system and opt into a monetary alternative that's not controlled by any centralized entity. So if you think about the Aussie dollars that you have in your bank account, it's all controlled by the Australian government and the Australian Central Bank, which is the RBA. And they're the ones that set rates. They're the ones that decide if they want to print money and increase the money supply and devalue the money. That is all managed by a centralized entity, whereas cryptocurrencies are an opportunity to have a monetary system that is fully decentralized, which means that the security and the upkeep of the system is managed by nodes that sit all around the world, so that no single actor, no centralized entity, no matter how big, like the US government, for example, can shut it down essentially. So it's a system that's so decentralized that the US government, even if the US government were to ban Bitcoin, for example, in the US, that it would still be able to continue. And so that decentralization of finance and the opportunity to store the value of your money in an asset that isn't deflating, that isn't inflating and has a fixed supply is the allure of blockchains generally, because as I said, people have lost faith in traditional financial institutions. Bitcoin was the first one to come about in, I think, 2008, and that was followed by Ethereum in 2014. And there are now something like 18,000 cryptocurrencies listed on CoinMarketCap, which is your like the go-to place to look at how crypto assets are performing. From a size point of view, you can see that the size disparity is pretty substantial. So Bitcoin is currently worth 570 billion in market cap. Ethereum, the second biggest one, is half of that at around 245. And then the third biggest is only 75 billion. So if you think about the size of crypto assets generally, there's a huge skew towards the largest two assets, which are Bitcoin and Ethereum. And all other assets are sort of considerably smaller than that. You can see even by the time we get to the seventh or eighth asset, you're down to 19 billion in market cap. I was thinking I would go more into like the origins of Bitcoin and Ethereum and what they are, but I might just end on blockchains. So the idea of Bitcoin and Ethereum and all of these 18,000 coins that have now come into existence is based on this concept of a blockchain, which you can think of as a distributed ledger or a distributed database of transactions. And so each, let me show you this, where every block in the chain contains a stack of transactions that have occurred between the time that the last block was minted or onto the blockchain and the latest block has been minted onto the blockchain. So here's how it works. So let's say I want to transfer has $20 in Bitcoin. So I'll make the request. I'll authenticate it by giving the private key to my Bitcoin wallet on my computer. That will then get processed into a block. So the latest block that's being essentially computed by the network, my transaction gets added onto that block. It's sent around to every node in the network, or let's just say for simplicity, every node in the network. The nodes then validate the transaction. In the case of Bitcoin, they do this by solving complex mathematical problems. And essentially, the nature of these problems is such that they require a lot of compute power to solve the problems. But then once the problems are solved, it's very easy to verify that they were correct. So that's kind of like the high level of how this hashing process works, as it's called, the computation. And then nodes that participate in this process and that successfully solve the hashing function receive a reward. So in Bitcoin, which is what's called a proof of work system, they will receive some amount of Bitcoin as a reward for contributing their compute power in the form of electricity and GPUs to the network. And then once they solve that hash function, the block gets added to the blockchain and it's there forever. And then this update of the new block is then distributed across to every node of the network that updates the blockchain. And then the transaction is completed. Now, most of these blockchains can do this extremely quickly within some within less than half a second, and others in a little bit longer. But that's essentially the process of how blockchains work. And the concept is that these blockchains are completely decentralized and distributed such that, or at least in the case of Bitcoin and Ethereum, they're distributed in the sense that, and decentralized in the sense that no centralized actor can shut down the network on their own. And that's like a bit of an intro to crypto. I'll also give a view on NFTs. I don't think anyone should bother investing in NFTs. The reason being is it's an extremely complicated market. There's very low what's called like liquidity in these markets. Liquidity is influenced by the amount of transactions that happen. So for example, if you think about CryptoPunks or Bored Ape Yacht Club, which are like the two premier blue chip NFT projects, they only have 10,000 NFTs within the whole of the Bored Ape Yacht Club NFT collection. Now, 10,000 NFTs can only change hands so many times. So as a result of that, it's very hard to pinpoint exactly what the price of one should be and what the fair value of one of these assets should be. So a lot of it's based on speculation. And then the second thing I would say is that whenever you invest in an NFT, I would think of it as leveraged exposure to the cryptocurrency that the NFT is based in. So for example, if you want to buy a CryptoPunk, CryptoPunks are based on the Ethereum blockchain. Now, what that means is that these NFTs are priced in terms of Ethereum. So not only are you exposed to the price of the asset in terms of Ethereum, but then you're also exposed to Ethereum as an underlying asset. Because if Ethereum, let me give you an example. So for example, if I buy a CryptoPunk for 10 Ethereum and Ethereum is trading at $10, then I've essentially paid $100 for that CryptoPunk, right? Because 10 Ethereum worth $10 each means it's a $100 CryptoPunk. Not only do I have to worry about whether or not the CryptoPunk price goes up or down from 10 Ethereum, I also have to worry about whether or not Ethereum is changing from a value of $10 per Ethereum. So that's why I've described it as leveraged exposure to the underlying cryptocurrency. And so usually if you want exposure to Ethereum, you might as well just invest in Ethereum. You don't need to worry about levering that by investing and speculating on another crypto project on top of it. That's just my view. Obviously, you're welcome to speculate, and there's a lot more with NFTs that I can talk about. I've got a shocking example of one that I invested in as well. In fact, yeah, I might as well just end on this. So I probably about 7 months ago, I bought, actually, let me show you. It's that ridiculous. I bought an NFT on the Solana blockchain called, I'll just show you, called Piggy Soul Gang. Now, what this essentially was, it's not for the artwork. I don't think the art looks good. I don't think the name's cool. I bought this because what this is an NFT project that was started by this NFT exchange. And what they were promising was to pay out to all the holders of this NFT. They were going to pay out 30% of the royalties that the exchange earned on every single transaction. So if you think about every NFT that's listed on this transaction, every time an NFT sells, the platform takes a 2% fee. So if one of these sells for $100, the platform takes 2%. So it takes $2, and then they promise to pay out 30% of that. So 30% of $2. And so as you can imagine, like these platforms have considerable amount of volume going through them. And so there'd be a huge amount of fees to then get distributed to the holders. And then I was hoping that that would get basically paid back, and that would cover the cost of buying the NFT itself. So I bought this NFT for 10 Solana, and you can see that now they're basically down to 2 Solana because the project got into legal issues associated with distributing royalties, because then it was technically a security under US law. So then the price is just absolutely tanked. So, you know, crypto is, as it's been described, as like the Wild West. Like we don't know where regulation's going. We don't know what's legally allowed and what's in legal gray area. So it's easier to just stay away from it, to be completely honest. Especially if you don't fully understand the underlying blockchain technology yet, which I wouldn't expect you to understand. It takes ages. Yep, Kira.
You might have been getting to this, like if we had more time, but like, do you think that the concept of like central bank digital currencies are completely irrelevant considering the purpose of blockchain, or like, do you think it'll work?
So yeah, so it's a good question. For people that don't know, central bank decentralized currencies are, I describe them as like an on-ramp to crypto. So the idea of them is that they're cryptocurrencies that are tied to some fiat currency, so or pegged to a fiat currency. So for example, there's one called True AUD, which is if you hold one token of this True AUD on whatever blockchain it's on, you can redeem that for $1 Australian, and that all of those assets, all of those cryptocurrencies that they mint, all of those True AUD that they mint will be backed by $1 Australian. And so the reason that I think they need to exist is because it gives people an opportunity to basically be within the crypto ecosystem and hold these coins without being directly exposed to like Bitcoin or Ethereum. And then you can buy or sell and swap your True AUD for Bitcoin when you want to get in, and sell out to True AUD when you want to get out. So I think it's an important on-ramp. The difficulty with it is, as I said, it's really important to understand what you're investing in, whether it's shares or cryptocurrencies. There is a huge discrepancy in types of central bank decentralized currencies, but I would describe them more generally. That's a subset of what's called a stable coin, which is just a coin that's pegged to some fiat currency. When I say fiat currency, it's like US dollars or euros or pounds or AUD. And so I think the central bank decentralized currencies, that is a subset of stable coins in which the central bank, like the RBA, issues these digital currencies themselves to give people an opportunity to buy into them. The difficulty with them is that if I'm trying to opt out of a financial system because I'm worried that central banks have lost control, then why would I buy an asset that central banks have issued and have complete control over? Like the whole allure of cryptocurrency is the concept of decentralization, in which no single centralized actor has control over the supply of the money that's being circulated. And so I think it's a bit of in fact, it's like positive for the crypto ecosystem because more people get into crypto, but I don't think that longer term people will hold any money or transact too much in central bank decentralized currencies. Yeah. Alrighty. So hopefully that was informative. I think we've covered quite a bit, from simple stuff to some slightly more advanced stuff. Hopefully something for everyone there. And there's a lot more detail we can go into with crypto. I would recommend for anyone that hasn't already, please take a look at the video that I commented on the original post. I go into way more detail of what blockchains are and how Bitcoin came to be, and how like what Ethereum is as well. Alternatively, you can I have a blog. This is such a shameless plug. I have a blog. I'm actually going to post about. I've already made a couple of posts on stablecoins, and like what I think of them. I'm also currently drafting a post about a recent stablecoin that just went to zero in the last like 5 days, which had huge repercussions for the crypto industry more generally. So if you want to take a look at that, feel free. Some other resources, CoinMarketCap has this platform called Alexandria, which is like a Wikipedia or encyclopedia for all crypto concepts. There's a lot of really good stuff in there. And then also A16Z, which is a large crypto venture capital firm in the US, has something called the Crypto Startup School, and they have a lot of good stuff in there as well. Cool.